My name's Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. Alex, thank you so much for joining the What the Finance podcast to talk with me today. So on to my first question. Obviously, you're creating Wealthyhood, which is a platform for investors. What would you say are the greatest mistakes that you see retail investors make?
Well, I would say they make a few, but the most important one, I think it's actually not investing. This can be either because they are scared, it's probably their first time, they're not sure about how to deal or to create a portfolio. And if you just think how important your opportunity cost is when you don't invest your money and just let it lose its value due to inflation, it's actually huge. The second is, instead of investing because you're scared, not investing because you're waiting for the perfect timing. So this is obviously, we've all done that. We've been there, but the perfect timing doesn't exist. I think it's never going to be perfect. There would always be a few concerns. The price may not be right and all that stuff. So again, like the previous one, better get in early than actually wait and lose time and actually see your money losing its value. So not investing for different reasons, one of them. Second is the exact opposite, being very active with your investment. So either checking the price too often, I think you are one of them, or buying and selling because you think they buy the deep, sell high, and all that stuff. The more active an investor is, or the more closer to a trader you become, the higher the chances you make some mistakes. And we all make mistakes, but we can eliminate them if we don't take action that often. So especially for beginner and less sophisticated investors, being very active is probably not the way you should go. And the last one is, I think, being emotional. Okay, we're all human. We're not super rational. We do have fear. We do have greed. But letting your emotions play a vital role in your investing is definitely not the right approach. So being scared when your investments go down is not the ideal thing to do. Being very greedy when your investments go up is also as bad as the former. So try to move a bit your emotions aside, try to monitor yourself, try to find justification behind your decisions. And if you cannot, just don't be active. Follow a passive approach. We still come back to the second point.
Yeah, definitely. I think sort of the first point you mentioned there, it's like you see the classic compounding charts where if you start like 5 or 10 years earlier, you're going to have like double, of
Exactly.
the amount. Yeah.
I actually posted one thing a few months ago. So there were two scenarios. On the one, you invest all your money in the bottom of every single market. In the other, you invest on a monthly installment. So the latter one proved out to be much, much more profitable for an investor, even if you could, let's say, predict the exact bottom lows of the market. So doing something like dollar cost averaging or spreading out your investments on a monthly basis is much, much better than actually aiming to time the market.
Yeah, definitely. I think sometimes a lot of us are, especially if you're a young investor, you're impatient. You want to try to, get the money as quickly as you can. But then a lot of the time people put risk management out the window and then you've taken those losses. So as you said, it's linking back to trying to be less active and less emotional in trading.
Yeah, exactly.
Do you have any advice for people to be able to, be less active and less emotional?
I think the most important thing is just to acknowledge that you are very emotional or to acknowledge that you are active. It's not okay to actively trade the market, especially if that's not your day job. It's okay if you just want to play around. If you consider yourself an investor instead of a trader, just try to monitor how often you act. You can try to turn off your notifications from your trading apps, for example. That's one thing to do just to get started. The second is try not to see the prices that often. The other is try to actually use a journal on how often you submit a trade, and then go back to your journal and see, was it justified, or I'm just seeing the prices too often and I'm actually lured to trade more and more and more. So I think this is the most important thing to get started. Before getting started, it's also important to set your goals in advance so that you have a realistic expectation of what to expect. Just have some target prices on your investment. So if you invest £1,000, say it's okay to lose 20% of my investment, or it's realistic to expect a 10% return year over year. And all that stuff builds back into having a plan and sticking to the plan, and again, not trying to reinvent the wheel as you proceed.
Yeah, definitely. So do you want to maybe talk about your journey in finance and startups and sort of how have you got to this point as well?
Yeah, sure. I mean, actually, my background is very, very different to investments and startups at all. I'm a computer engineer. I studied back in Athens. I think it was 2008 when I started my undergrad. I then graduated 5 years later, had a master's at the London School of Economics. It was health economics, again, completely irrelevant to the markets. Worked for a few years in healthcare information systems, mostly in product and business roles. And then I just realized I'm very into the markets and all that stuff. I did it for fun in the beginning, but I then decided to switch industries. I did a second master's at Imperial in investment and wealth management. And then I joined Morgan Stanley on the trading floor. This was my actual beginning in, let's say, trading or investments or finance in general. And my journey in the startup world came actually 1 year later when we decided with Kostas, co-founder of Wealthyhood, to start our own company. In the very beginning, it wasn't Wealthyhood. It was a different project. It was called Daedalus. It was some sort of an investment platform with a blockchain component where you could take private investments like hedge funds and venture capital funds and stuff like that and tokenize them so that you can lower the minimum entry requirement. Anyway, this doesn't make, it's not that important. And a year later, we decided to move on to Wealthyhood. So we're a bit, almost 2.5 years down the way, and 1 year for Wealthyhood, and actually 4 years more active into the markets.
Yeah, it's really interesting. And was there sort of like a moment or anything like that sort of you decided to go into finance or trading?
I don't think so. I mean, I recall having discussions with a few friends who were studying finance, and I think it was like 2014. I was 23. They were trying to, I was actually asking, what is a bond? I had no idea what a bond was. So I'm not this guy who was since 16 years old, knew everything about finance and all that stuff. I was asking what is a bond by the age of 23. And my friends didn't know actually. So I had to find out on my own. And then, okay, I soon realized it's not that bad. That's interesting. And it has all that math and stuff, which really caught my interest. And then I actually started watching a few movies, The Big Short, reading more about the financial crisis, and all that intrigued my interest. Then tried to put together my computer engineering skills to try to create a few algorithms to trade. That's all before I switched to finance and trading. It was awful. Never worked. And then, yeah, I couldn't say there was a moment. It was a combination of events and probably an intrinsic interest from the very beginning.
Yeah, definitely. And you mentioned there that you were sort of trying to build like a blockchain platform. Can I ask why you sort of moved away from that? Is that just you found this a better strategy?
That's a good point. It's actually very well connected to how we started Wealthyhood. So, I mean, private investments are not for everyone, and they're definitely not for your whole portfolio. So at the time, we were pitching this investment platform as the perfect place to allocate 10 or 15% of your whole portfolio. So we're saying, okay, you have a portfolio, it must have any sort of ETFs and stuff like that, but then you should invest like 10% of that to market neutral strategies like hedge funds or private equity funds and stuff like that. And then they said, okay, it sounds interesting. We probably do that. But can you help me how to create my remaining portfolio? So the rest 90%. And we thought, okay, I mean, just Google it. I mean, I'm sure there are going to be like thousands of different resources and ways for you to create the rest of your portfolio. And then one friend came, the second friend came. There were suddenly many, many friends out there who were asking how to create the 90% of their portfolio instead of the 10%. And we thought, okay, let's try to find out ourselves. And we soon realized that there wasn't a profound answer to that. There wasn't all the material and all the resources that these guys needed. So this is how we decided to create a portfolio tool. It wasn't a product yet. It was just a portfolio tool to help them create the 90% so that they could then put the 10% to us. And then we soon realized it was much more popular than the private investments. So we just pivoted to Wealthyhood, and we brought this tool to actually become our core product. Coming into that, there were many problems and difficulties to all of those friends who were trying to create a portfolio. One of them was, okay, I have no idea, how should I split my portfolio? Let's say X% in stocks, Y% in the bonds. Okay, I can figure this out. The second is, okay, where should I invest? Should I invest in US stocks? Should I invest in European stocks? Should I invest in tech stocks, biotech? Where? Which themes, which industries, which assets? And even if I have the themes, the industries, the asset classes, and the jurisdictions, everything, which ETF should I pick? Should I pick the one from iSearch, the one from Vanguard? And why should I pick the one over the other? So taking all these simple steps and putting them into user experience that's very simple for the user to follow, even for beginner investors, and then having this solution and one single ETF for each different combination of characteristics was what we decided to do at Wealthyhood. So we save time from our users, even from the due diligence process, but also to the remaining parts of creating a portfolio.
Yeah, definitely. I find it interesting. I know for myself, I've been investing for a few years, and it's easy to sort of forget how hard it is to learn and how much you need to learn and how difficult it is. And I think sometimes, these platforms and finance people as well, they forget that for investors, it's so daunting, isn't it? There's so much information, it's hard to find.
Exactly. And I mean, you're completely confused. I mean, I don't know if you're using trading apps, but when you open a trading app, you just face thousands of different stocks, bonds, ETFs, and more complex terms like derivatives, options, everything. The beginner investor has no idea which ones to pick, why to pick them, and actually what to expect if I invest in A or B or C. Not even creating a complete and diversified portfolio.
Yeah, definitely. I know for me, if they're like me, I'm a bit lazy and I don't like spending time on learning. So, you just want to get into it, and then you're like, hang on, I probably should have spent the time to learn. Yeah. Definitely. So you mentioned sort of portfolio diversification there, and I know you've made a post recently about your own diversification. Yeah. So can you maybe talk more about that and sort of how you devise that?
Yeah. So I mean, for my personal portfolio, I actually follow what's known as a core satellite approach. So there's a core part of my portfolio, and I only use ETFs for this part. And then there's a satellite with a few individual stocks. For the core part of my portfolio, which is the largest, like 90% of my portfolio, I have a split of about 65% in stocks, 15% government bonds, 5% gold, and 5% real estate. Again, everything is ETFs in there. And when it comes to my stock allocation, the 65%, again, I have some core and investment themes. So my core are US stocks, European stocks, and UK stocks. And my investment themes are around technology, clean energy, and healthcare ETFs. In technology, I have semiconductors, digitalization, artificial intelligence, cloud computing, and global tech companies, all equally split. And these are the things that I actually really believe in for my long-term portfolio. When it comes to my healthcare allocation, I have biotech companies and healthcare innovation companies, and then just one clean energy ETF. All that equally split. I'm not trying to just identify the perfect or ideal split between them. I'm not trying to overfit the past data, just equal split among them. And for my government bonds, I just have US, European, and UK government bonds for the 15% again.
It's interesting because obviously, if you look back 20, 30 years, 40 years, it used to be 60% equities, 40% bonds. And now, even 15% bonds is quite high for portfolios. A lot of people have a lot less.
That's true, actually. But you need to find ways to diversify your risk. So I'm not saying that government bonds are the perfect diversifier, but there's still some place where it would just keep your portfolio standing when everything goes bad. And you definitely need that. The other thing that I do is what I mentioned at the beginning, to diversify not only in the asset classes, but also in the timing to the market, is the dollar cost average. So I have this portfolio and I just invest a specific amount every month. So no matter what happens, I would buy the lows, I would buy the highs, and this just balances out, and I would just have the compounding effect of my returns.
Yeah, definitely. And you try to make sure that the diversification and the allocation stays the same throughout the whole time.
Exactly. Yeah.
Yeah, perfect. And I know sort of one of the things that your platform is trying to do is sort of reduce the secret costs of investing. Can you sort of talk more about that and what people should be aware about?
Yeah, there are many things that you're probably not aware that you are charged when you invest your money. And as I like to say, if you're not paying for the product, you're actually the product. I would mainly split it into three things. So the first one is transaction costs. There are some apps and platforms that charge a commission. A commission, it's what they say, like, you pay me £10 for every stock you buy. You may buy £20, you may buy £100,000, you pay me £10. This is just a straightforward commission. The second, you probably know that. If you're paying a commission, you know that. But the second is the FX spread. So many people are not aware that if you have euros, for example, or pounds, and your asset is in dollars, you pay an FX spread, and it's not that low. So the lowest in the market, I think it's 0.45% or 0.5%, which is actually not that low. FX spread is an important transaction cost when you invest frequently. And the third one is a typical execution spread. This may come in two ways. The first way is your broker just charges you the spread between the bid and the ask. And the second is your broker doesn't execute your trades. They just route them to market makers. So this is, it's a very well-known strategy, probably mainly in the US. Robinhood and other apps, just their main source of revenue come from market makers who pay them for order flow. So as a user, as an investor, you just get screwed when you execute your orders, and you face a cost that is not apparent, and there is no way you can know about it. And if you do that over time and many times, and if you trade frequently, this compounding is actually very, very important. So these are transaction costs. The second is account charges. This is not that large. For most of us, we don't have millions or billions. It's a specific amount, like 10 bips or 15 bips per annum. It's not huge, but it's probably something you have no idea that you are paying. And the third is where people start becoming creative, and it has to do with all the margin accounts. There you're in the mercy of your broker. They can charge anything for just holding a margin account overnight. So if you hold a position on margin today, tomorrow, and the coming days or weeks, every single day, you pay a specific amount or cost for your margin account to your broker, which you probably not aware.
Yeah, definitely. And I know, you mentioned Robinhood there. I think the majority of their income comes from crypto and derivatives.
Yeah,
that's where a lot of it comes from. So you're saying that's
and payment for order flow. Actually, this is very important. I think they're making like 80 billion per quarter just for order flow.
Yeah, well, I think it's payment for order flow, but it's for those specific assets as well. Not just stocks. Yeah,
especially derivatives. Yeah,
definitely. And I think one thing I've seen as well for a lot of these brokerages is they have lots of conflicts of interest. So sometimes if you make a trade, they'll actually trade against you, or all these small little things that they'll do. That sometimes they'll go a little bit extra and stop you out. It's crazy how they can get away with it sometimes.
That's actually crazy. I was very furious back in January when we were watching the whole GameStop story unfold. there are definitely conflicts of interest. They have full power over your trades, over your orders. I'm not gonna say that they are front running their clients, because I mean, this is on the regulators to judge you, and I don't have any proof to prove that. But they can do many stuff, from just sending random signals to liquidate your margin accounts, which happens, or to just sell your orders again to market makers and making money. Actually, their revenue streams come from their major clients, which are the hedge funds. All that stuff is conflict of interest, and it's definitely not on the best use for the individual investor.
Yeah, definitely. And do you think sort of anything needs to change for retail investors? So obviously a lot of the times they can be, you can almost say that they're being taken advantage of.
I mean, many things need to change for retail investors. One of them is the regulators need to take some serious action when it comes to all the conflicts of interest we mentioned before. They will probably do that, or they will be scrutinizing the individual companies, and I hope this will end up well for the individual investor. But that's on the end of the brokers and the regulators. On their behalf, millennials should definitely change their mentality when it comes to investing. So nowadays, it's probably okay if you are gambling with your stock trading app, if you are just looking for the next GameStop or the next AMC or any potential stock that could make you a millionaire overnight. It's not okay. You should be investing and you shouldn't be trading, and you should at least understand the difference between speculation and investing. If you want to speculate, just don't spend all your money, if that's okay with you. If you want to invest, this is not the way to do it. So at least 80% of day traders lose money within 1 year. This is a statistic that most people overlook when they hear the friend who made like a few £1,000 trading meme stocks. So number one, they should change their mindset. They should become investors and just not trade as much as they're trading today. Number two is they should educate themselves. So I'm not saying you should become a guru or have a PhD in finance in order to start investing or just buying a few stocks, but you should have some basic understanding of basic principles. So what's compounding? It's very, very important. It will affect all your investment decisions. You should definitely know that. Set some realistic expectations again. It's not realistic to expect that you will double your money in 1 year and continue to do that over the coming years. That's not realistic. If you are doing that, then you have a huge risk somewhere else in your portfolio. Set realistic expectations, educate yourself, understand what you are investing in, avoid things you cannot understand. Like if you don't know what's a cryptocurrency, you should probably not hold Bitcoin or anything else. Stick to the basics, understand the compounding effect, just have a portfolio, invest in it every month, and you just be a winner out there.
Yeah, definitely. I think that's really good advice. So you mentioned crypto there, but you didn't mention in your portfolio. Is that something that you have included or no?
Yeah, I mean, I have some cryptos. It's like 2% of my overall portfolio. So it's a long-term bet. I'm not saying that I'm not following the market, but it's definitely not the core part of my portfolio. I have Bitcoin. I have a few very tiny ones, which are like just a bet, but they're a very minor part of my portfolio.
Yeah, definitely. I think it's what we mentioned before. It's sort of your risk tolerance. If you're younger, you may have a little bit more of this crypto in your portfolio, but if you're a bit older, about to retire, you're definitely not going to want too much of it.
I mean, it must be in line with your expectations. So if you're okay, if it goes like 50% down, that's fine. You can hold crypto. If you're not okay, then you just reduce your exposure there.
Yeah, perfect. So we'll go on to Wealthyhood now. So obviously you mentioned it before. Sort of what are the benefits that you're trying to provide for investors? I know you've mentioned a few, but can you expand?
So essentially, with Wealthhood, we're trying to actually find a place to provide all these features and the user experience I described before in my individual portfolio. So we're essentially trying to build a do-it-yourself wealth building app focused on long-term investors. And we claim to guide long-term investors to build their wealth over time by intelligently investing their money the way they want with fewer fees. So we want to find the perfect mix of both personalization and also automation to help our users invest their money, even if they have no idea how to do that. It's not trading. It's not handling your money to someone else to manage. It's something in the middle, what we call do-it-yourself wealth management. And the whole experience is focused around three main components. The first is that we want to offer all these smarter tools, all the guidance that's missing from the trading apps, and just to take the investors from the hand and guide them through their investing journey. Will help them develop, fine-tune, and automatically maintain their investing portfolio. The second is that we want to make this experience as personalized as possible. So I'm sure you know a few robo-advisors like Nutmeg, Wealthify, and the likes. They do offer some sort of automated investing. It's actually giving your money to them to manage, but it's definitely not personalized. So we want to bring back all this personalization that's missing. You're a different investor than I am. Everyone is different. You may want to invest in tech stocks. You may want to invest in communication stocks. You should be able to do that. Portfolio should be able to facilitate that. And the third is that we want to do that with simple and transparent and lower fees. We don't want to just have hidden fees everywhere. We want to be transparent with that. And I couldn't just argue that we are better than the others and still do the same mistakes. So smarter tools, personalized insights, and fewer fees to a new way of investing, which is portfolio-based investing instead of individual security investing.
Yeah, it's interesting. So rather than someone having to, divide it up and have a spreadsheet and try and divide it up between all their investments
exactly, yeah.
Platform, yeah.
I mean, if you think of it now, if you open one trading app, you just have to, let's say you want to invest in 20 stocks. You buy one, you buy the second, you buy the third, and then it all aggregates to one portfolio. The reverse is you have 100% of your portfolio and you decide how you want to split it. If I want to put additional £1,000, I will put it to my portfolio. I will not have to put it to the individual 20 stocks one by one, doing the calculations by hand, or just risk managing through an Excel file, which is super complex. So yes.
Well, when you mentioned that, I was just thinking about the complexities of it. And, obviously if one asset does better and you have to reweight it. And I was just thinking about it. I was like, oh God.
This is too complex to do by hand. It's very simple if you have an automated, so it's not rocket science. Your investing app should be able to offer that.
Yeah, definitely. And I think another thing as well, you mentioned obviously wealth management firms, they obviously have a fee. So it could be 1-2% plus. And over that 20-30 years, if you compound that, the loss of gains could be
exactly
huge.
That's actually one of my main fishing points. The average robo-advisor charges you like 0.8% to 1% per annum. So 1% may sound small, but if you compound it for the next 30 years, if you are in your 30s and you're investing for your retirement, this translates to 1/3 of your wealth. So 1/3 of your wealth will end up to your robo-advisor instead of ending up to your pocket, it's huge. It's just the 1% of fees, just switch to someone else.
Yeah, it's crazy to think. So one thing you mentioned before is like you have your 10% of sort of individual stocks, and it seems like a lot of them are, you're looking into the future and sort of the future trends and what's going to happen, like AI and a few others. Can you talk a bit more about sort of what you're looking at for the future, just personally?
To be honest, I have mainly biotech stocks when it comes to my satellite part of the portfolio. But when it comes to the future, I just believe in the trends I have in my core portfolio. So the ones you mentioned, AI, cloud computing, and digitalization in general, and also biotech and clean energy. So I'm likely this can be easily expressed to you through the best ETFs out there. So no need to bother just picking the ETFs and having exposure to the market and the industry instead of just cherry picking the ones I think will be the winners.
Yeah, and I guess that comes from your past experience with health and understanding that a bit more. Is that why?
I don't know. Actually, I haven't thought about that. Could be that, but I'm also intrigued by biotech, so it may be from my previous experience. Yeah, you're right.
Yeah, and it is super interesting. Sort of, we've obviously seen through COVID the importance of health and the importance of basically healthcare advancing from where it is at the moment. So I even see, you just see some people, if they have like the I worked with someone who had the thing for diabetes where they scan it every single day, and it's just crazy to think. And I guess the amount of products like that could be available in the near future are going to be huge.
Exactly, you're absolutely right. So There's huge innovation taking place in the healthcare sector. There are still lots of things to be done. I think COVID accelerated many of these developments, and I think in the near future we just have all that stuff that we couldn't imagine 10 years earlier.
Yeah, definitely. And then when you invest in those companies, is it more about like the products they're developing and sort of, are there any specific products or sort of parts of healthcare that you're watching yourself?
It's mainly parts of the healthcare's, let's say, feature or product set. So, for example, oral vaccines, DNA technologies, mRNA drugs or vaccines again. So general themes, not specific products.
Yeah, okay. And then the things that will have massive impact on, obviously,
Exactly.
all people. Yeah, perfect. Alex, thank you so much for joining the podcast today. My last question is sort of, what is one message you'd like people to take away from our interview?
Okay, I haven't thought about that, to be honest. I would say it's not bad if you don't understand how to invest. It's bad if you think you understand, but you don't. So don't think you need to actually beat the markets. Keeping it simple, it's probably the best way to go and even beat the day traders that are out there. That's it. Thank you very much, Anthony. It was a pleasure discussing with you. Hope our audience enjoyed that.
Yeah, thank you so much. So if anyone wanted to hear more about yourself, or obviously your new product, where would the best places for that be?
I'm very active on LinkedIn, so my LinkedIn profile will be probably the best way to do that.
All right, perfect. I'll put that all in the description below. So Alex,
Okay,
thanks again.
Perfect. Thank you very much, Anthony. Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.